All right, Chapter 23, Operational Budgeting. And so they start out by talking about this company, NTI, and how this company is financially profitable, but yet seems to have quite a bit of liquidity problems, meaning they're not able to meet their obligations as they come due. And so the question is, how can a company be, in this case, doing better than average from a profitability standpoint, but yet have so many cash flow problems? And as they indicate, the real problem is for companies that are in a fast growth period. Well, how can you be profitable and be cash poor? Well, remember, profitability is measured on the accrual method of accounting, and you can earn revenues even though you've not actually collected cash. So that's what, you know, when you're talking about cash flows, you're talking about the cash method of accounting. When you're talking about profitability, you're referring to the accrual method of accounting, and it's two different ways of thinking, which is one of the main reasons why we have the cash flow statement as one of the four required statements under GAAP. And so for this company, profitability ratios look good, but liquidity ratios not so good. They are below their industry's average, and in some cases quite a bit. Current ratio of 1.4 versus industry average of 2.4. That's pretty telling. Quick ratio of 0.6 when industry average is 1.5. Inventory turnover and accounts receivable turnover quite low when compared with industry averages. Accounts receivable turnover, almost half of the industry average. And so they're collecting only 4.5 times per year when the industry average is 8 times a year. That means that on average, companies in their industry are collecting, turning over their receivables about every 35 days. Excuse me. What would that be? It's not 35. Let's see, let's just take 360 and divide it into 8. 45 days, excuse me. So, and it's taking them somewhere between 80 to 90 days to collect. So that's not good. And when you consider the operating cycle for this company, it's a really long operating cycle. They've got their money tied up in inventory and receivables way too long. I think the book says like 270 days. So it's taking them 9 months to take cash up front. They're paying cash up front for materials to produce their product, and once they make that product, it sits there as inventory until sold, and once sold, it sits there as an uncollected accounts receivable until it's paid and turned back into cash. So your operating cycle is how long it takes to turn inventory and receivables back into cash. So you got a big outlay up front to produce the goods, sell the goods, and then turn it back into cash. That's what causes these problems. And if you're in a rapid growth phase, you're going to have this continued friction, if you will, tension, in that even when you collect cash, you're going to have to turn around and invest that cash into more inventory because you've got more demand. So you really have to think ahead and determine what's going to happen with your company so that you're prepared. What could this company do? I mean, it's kind of a curse and a blessing to be in a rapid growth phase, because you don't know how long that's going to last, and then you might be in a slow growth phase sometime in the future. So you've got to be able to take advantage of the fast growth phase when it comes. Well, what does this company need to do? As it indicates, the owner has to put money into the company just to pay payroll. Well, what should have occurred is they should have thought this ahead as best they could and arranged for financing so that owners are not having to divvy out of their own pocket to pay the company's expenses. Figure out when they need additional cash, go to a financial institution, get a line of credit that will probably be financed or secured by the inventory itself. But apparently they didn't do that in this instance. And so here we show this example, 247 days it was, that their cash is tied up into inventory and accounts receivable. I mean, if accounts receivable terms are 30 days and they're collecting an average of 81 days, there's a problem there that they need to fix to try to, number one, make sure their inventory turns over quicker, but also once inventory is turned into a receivable, that they collect the receivables faster. Because if you've got a 30-day term and you're getting paid 61 days after that term, you got to ask yourself, well, what are our credit policies? Is that what's affecting this? Are we too lax? We accepting too many questionable customers? Or are we just not doing a very good job of collecting? Don't know. Doesn't give us enough information here. And so how we, or at least, and again, this is not necessarily the answer to all of that company's problem in our example, but it certainly would help if they were budgeting for their cash shortfalls. And so budgeting is the basis for planning and control. A budget is a comprehensive financial plan for achieving the financial and operational goals of an organization. And so planning and control are the key terms there. Planning helps you to develop your objectives for acquisition as well as use of the company resources. Control are the steps taken by management to ensure that objectives are obtained. Usually, those are done through this budgeting process as well as policies and procedures of the company. So what are the benefits derived from budgeting? Certainly, this budgeting approach is an overall company-wide budgeting approach. So all departments are involved in budgeting. It's also, most books that you read on this subject will suggest that it's a participative function. Budgeting is, meaning employees at all levels are involved in this budgeting process. And usually what you'll have is a budget committee made of people from all over the company, HR people, production people, sales people, VP of, something. Maybe the president involved in the budgeting process on the budget committee, but it's what we call a bottom-up approach rather than the company, the executives just making up a budget, and for each department just handing them their budget and say, here, live within this. You get a lot more people on board when they have participated in the budgeting process. Since this budget, the overall master budget, is made up of several other budgets, management at all levels must realize that how other departments are going to be affecting their department. And so production department, when they're budgeting, must determine how the sales department is going to affect their budget. And so there's enhanced management responsibility in this budgeting process. And so the companies and the managers are forced to consider all aspects of their internal activities, and they must make estimates of future economic conditions. Because managers, through these budgets, are given forewarning of what they can expect, it makes them responsible for and controlling of their piece of the budget. It helps to coordinate activities. So, preparing a budget provides management with an opportunity to coordinate the activities of various departments within the business. And then, last but not least, these budgets help in evaluating the performance of various departments within the company and how well those managers are planning and controlling the things that they have responsibility over. Now there's two ways of budgeting that the book talks about. There's the behavioral approach to budgeting, and then there's the total quality management approach, TQM approach to budgeting. I would think that most companies would use the behavioral approach. We're not going to get into, one versus the other, but basically, in the behavioral approach, it allows managers of the various departments to achieve their goals. And so the numbers within the budget are attainable. And so here's what I was talking about. This budgeting process should be a bottom-up approach, not a top-down approach. Again, if they're participating in the budget process, it helps them to sign on, convinces them to sign on to the process. And essentially, once the budget is done the way they like it, or in a way that's acceptable to various management of these various departments, basically they own it. And from a psychological point, I think they would feel that they should be held responsible for their performance under the budget. Now, what we're going to talk about is operational budgets. Capital budgets, where you're budgeting capital expenditures, are much more long-term than operating budgets. And usually the capital budgets are done at a higher level of management than operational budgets. So it's big picture stuff when you're talking about capital budgets. And so the operating budget, usually in most companies, what they do is they determine the various operating budgets for the whole year, and then they further break the operating budgets down into quarters and months. Some companies also have what are called rolling budgets, where once a month or a quarter ends, they simply add on, even though that additional month or quarter goes into the next year. So that's kind of a preference thing. And so here what we have is kind of a diagram of what we call the master budget. The master budget is made up of various operating budgets and financial budgets. The operating budgets being sales budget, production budget, cost of goods manufacturing and sold budget, sewing and administrative expense budget, and last but definitely not least, the cash budget. And then you have your financial budgets, your budgeted income statement, budgeted balance sheet, budgeted cash flow statement, and then your capital budgets or capital expenditure budgets. What we're going to spend time on in our example problem are some of these operating budgets, and especially the sales budget, the production budget, and cash budget. I think those are the three main ones. We might, I think, get into the cost of goods manufacturing and sold budget as a way to get to the cash budget. And understand that you have, just like you with when you were preparing financial statements in financial accounting, there was a step process that you had to go through. And if you recall, you started with the income statement and then worked your way into the other financial statements from there. Well, the same holds true for budgeting. There are certain steps that you have to take in preparing the master budget before you can get to a master budget. It starts with a sales budget. And so that's what starts it all, because if you think about it, you can't figure out how many units you need to produce until you know how many units you think you're going to sell in a particular time period. Once you know what your estimated unit sales are, then you can start planning production. How do you do this? Well, you might have as your starting point figuring out sales, historical information. Certainly you would want to include economic forecasts for your industry. Where's the industry going? Are sales going to be up or down? And then, of course, forecasting customer needs. through your sales personnel. Once you have determined your sales budget, you can take, and if you are a manufacturer of goods, figure out what your costs are going to be to manufacture the goods that you plan to sell. So here we have an instance where company estimates that, the marketing director within a company estimates that he'll sell 8,000 units in the first quarter and 10,000 in the second quarter, and then the sales are going to continue to increase in the third and fourth quarter, 30,000 units in the third and 40,000 in the fourth. Note here, they don't project a variance in the sales price, so that remains steady. So you simply take the sales price and multiply it by the projected unit sales in a quarter, and that's going to give you your projected revenue for that quarter. Now, again, you could do this for months as well. You could definitely break this down into months within that quarter to get more specific. Apparently, if I had to guess, this must be some sort of seasonal type of operation. Doesn't really say. Once you've done your sales budget, you go to your production budget and figure out what it's going to cost to make the number of units that you're going to sell. And so production must be adequate not only to meet what you forecast for a particular quarter or month, but you also want to leave in ending inventory sufficient ending inventory in case you're off. Let's say that sales are more than what you projected. Well, if you don't provide a cushion in your ending inventory to meet that unexpected demand, you're going to run out of inventory, and if it takes a while to manufacture this inventory, what's going to happen? Well, you're going to have to tell your customers that, sorry, I don't have enough inventory. Well, they're not going to be happy, and they're probably going to go somewhere else, and who knows, that may be permanently. And so the way you figure out your production budget in units is to figure out how many units you're going to produce and add this pad, this ending inventory. And so from an equation standpoint, it's your budgeted sales in units for a particular period, plus the desired product units in ending inventory, which equals your total product units needed. And from that total, you subtract the number of units that you have in beginning inventory. And that is equal to the number of units that the production department needs to produce. And so here, you take your projected unit sales here in the first quarter of 8,000, and apparently what they want to do is for that quarter have a desired ending inventory of 1,000. And so the number of units that they will have available for sale is that total of 9,000, but they have beginning inventory of 8,000 already, and so they only need 1,000 units produced. And so going to the second quarter, projected sales, unit sales of 10,000, and they want 3,000 in ending inventory, so total units available for sale will be 13. And note that your first quarter ending inventory of 1,000 becomes the beginning inventory for the second quarter. So units available for sale of 13,000 minus beginning inventory, beginning second quarter inventory of 1,000. And so they have to produce 12,000 units in the second quarter. And so it goes on and on. And of course, from a cost standpoint, they have to figure out how much it's going to cost per unit to produce these things. Whoop. And so the next thing they have to figure out is how much material they have to purchase. And so the way they do that is they figure out how many units they're going to produce, and they multiply that by the material needed per unit. And then to that number, material needed for units to produce, you're going to add the desired units of material in ending inventory, which is going to equal total units of material needed. And from that, you're going to subtract units of material that are in beginning inventory to come up with the units of material to purchase. On top of that, you're going to have to figure out, so that's the materials budget, but you still beyond that, you have your direct labor and factory overhead. So you can do a direct labor budget as well as an overhead budget. And so this is how you figure out those things. Budgeted production times labor hours per unit equals total hours needed for units to produce times cost per labor hour equals budgeted direct labor cost. And then you do the same for overhead. And so here's the combination production budget, which includes the direct materials budget, direct labor budget, and factory overhead budget. Now notice it's in, some of this is in dollars, some of this is in units. So make sure you understand what you're looking at. From there, you can prepare your cost of goods manufacturing, cost of goods manufactured, and your cost of goods sold budget. This budget estimates the cost of goods sold, and it's computed by using the beginning finished goods inventory from the beginning balance sheet and information from the production budgets. Selling and administrative expense budget, we probably won't go through that. It's pretty simple. We will not be doing an example of a budgeted income statement. We will do, and I hope if you understand or remember anything from this chapter, you'll remember how to do a cash budget, because this is probably the most important budget in the short term that you'll have. And so this includes disbursements for payables, prepayments, debt service, and taxes. So it includes not only inflow of cash, but it includes these outflows of cash as well. Because this is going to help you determine whether or not you have sufficient cash flows from operations to meet your budgetary needs. If not, management's going to have to figure out an alternative way to finance their operations, either through a loan, selling more stock, or whatever. And so here you start with your cash balance at the beginning of a particular quarter. To that, you add cash receipts to come up with total cash available. And then from that, you deduct the various planned cash payments. Here you have accounts payable. You have certain prepayments, you have debt service, and income tax expense. There could be more, and more than likely there would be more. And notice the ending cash balance at the end of one quarter is the beginning cash balance of the next quarter. And then from all of that, you can prepare a budgeted balance sheet, which we won't do in class, but just so you know. All right, benefits of budget. Advance warning and assignment of responsibility for conditions that require corrective action. It coordinates activities among all departments within the organization and creates standards for evaluating performance. right, we're not really going to hit on flexible budgeting. What I'll do in our example problem is tying some of these different budgets, operating budgets together. And so that's what I'll be doing here in a couple of days.